everyone. I hope you people are doing great. In the previous video, we have spoken about partnerships. Now we move one step closer. Now we are talking about limited liability companies. So this is basically a company. Now, what really is a company? A company is, let's suppose people come together, pool their money, and they form a company. A company is in itself a separate person. So what is the definition of a company? It is a legal person in its own right, separate from its owners. So if let's suppose 100 people pool their money, everyone contributes 1 crore, so it becomes 100 crores of company. Now this company has its owners, 100 people are its owners who own 1% of the company, but the company in itself, let's suppose this company is called FA company, financial accounting is what we're studying. So let's suppose this company is called FA company. So this company is a separate person. What do you mean? Legally, this company can own a car, the company can own a building, the company can have a bank account. So this company has become a separate person in the eyes of the law. So it is separate from its owners. Now, whose name will the assets be in? In the name of the company. So we will say that this is FA company's car. This is FA company's building. So this is how companies work. They are a separate person, legal person in their own right, separate from the owners. Owners, who are the shareholders, will be holding shares in the company, and they are going to require profits in the form of dividends and capital growth from the company. So if let's suppose you have invested money in a company, you buy a share of any company, what do you expect? You expect that the company will give you dividends, and at the same time the share price should also rise. So if you bought the share for 10 rupees, in some time from now it should be 15 rupees, 20 rupees, 30 rupees, and so on. So this is what the concept of a company is. Now let's learn about the different legal differences of liability, limited liability companies. So we will first talk about the change in business ownership. Now, because we are saying that the company in itself is a separate person, so shareholders can buy and sell shares in the market without having other shareholders to agree. So in the partnership, what was happening is, if I and Punya are partners, we want another person to come in. So that person can only come in if Punya and I, that means the existing partners, agree. But here in a company, you do not have to get the agreement of other shareholders. You can buy and sell your shares to anybody in the market. However, if you see the smaller companies, they are the ones who are going to possibly place some restrictions on selling in the open market. Why? Because they do not want the share prices to fall. So if let's suppose it's a new company, they are scared about share prices falling, so they may restrict you from selling to the market, because if you sell in the market, there's more supply. More supply and same demand means prices will go down. So no company would want that. Hence, smaller companies also have the option to restrict the sale to the market of the shares. So this is the first point. Next point that you see is business continuation. So in sole tradership, we saw that if sole trader itself dies, the business will come to an end. In partnership also, we saw that if the partners, if any of the partner exits or leaves or dies or retires, then the partnership comes to an end. But this is what is different in a company. Shareholders can change, but the company will not be affected. So if I sell my shares to somebody else, the company will still keep running the way it has been running. So continuity is not affected by change in the shareholders, change in the ownership. Next point is with respect to taxation. So because we are saying that company is a separate person, so like how government collects taxes from me, from you, similarly government thinks that the company is a person, so they are going to collect taxes also from the company only. So the company is liable to pay tax on the profits that it makes, and the rate at which the companies pay taxes is known as the corporate income tax rate. So individual owners, if I am the shareholder, I will not be paying taxes on company's profits. Company themselves will be paying taxes on their own profits. Next, you see ownership of business property. We've already spoken about this, how company is a separate person, so they can own their property also. So FA company, if you form a company like this company can have its separate bank account. they can have their separate property, they can have their separate building on the ownership of FA company only. So ownership of business property will be, ownership does not need to be in anyone else's name. Individual shareholders will not have any control over the property. So if the owner is the company, then control also will be in the hands of the company. Individual shareholders cannot go to company's property and say that this is my property. Then last point is with respect to legal action. So again, coming to the same point, that the company in the eyes of a law is a separate person. So this separate person can also be put fines. So if the company faces any penalty, who will pay the penalty? The company, not the shareholders. So if I am the shareholder, I will not have to personally go and deposit the fine. The company will deposit their own fine. So this is the legal action point. These are all the legal differences of limited liability companies. Now, if you people are clear with the concept of a company, we will now speak about the advantages and disadvantages. So the very first advantage that we have is liability. So here the shareholders are protected, because if the company goes into trouble, then shareholders' personal assets cannot be used to repay company's debt. As we saw in sole trader, as we saw in partnership, that if both of the businesses fail, so the personal assets of the sole trader or the partners can be taken to pay the debts of the partnership or sole trader business. But when it comes to a company, personal assets of shareholders cannot be taken. The only loss that the shareholders will be bearing is the amount of capital that they have invested. So if I have invested 100 rupees in the company, maximum loss that I can face is 100 rupees, not more than that. Any more loss cannot be taken away from me. So limited liability will protect directors and the owners from legal actions brought against them. Shareholders' liability will be limited to the value of their invested shares. So if I bought shares of 100, my maximum loss can also be 100 only. Personal possessions of the shareholders. So my personal assets cannot be used to repay the business's debts. So my investment only can go away. Rest, I cannot face any other losses. Then the next advantage is with respect to raising finance. So here companies will be able to easily raise more money. In the case of public companies, we can go to our shareholders only that we need more money, and they will be able to give us more money. So this is how raising finance becomes easier for companies. Then business continuation. This is also one very big advantage, that shareholders can keep trading their shares. I can sell today, buy tomorrow, buy today, sell tomorrow. So this I can do, but this will not affect the company. So this is also an advantage. So the company can keep running no matter how much the ownership is changing. So this is your advantages all sorted. Now let's come towards the disadvantages. So disadvantages of limited liability companies, the very first point that you see over here is with respect to the costs. So like I told you people, sole traders, partnerships are still relatively cheaper to form. But if you talk about the cost of forming a company, it is a very heavy initial investment. You can see substantive initial investment, and you're going to have to do a lot of more admin work also, because companies are supposed to publish their financial statements also. This is also spoken about in the last point. Let us first get to taxation. So we have already spoken in the features and the legal differences that the company pays taxes on its income. So the profits are taxed, the shareholders or the directors are also individually taxed. So in a way, we are paying taxes twice to the government. First, the company pays tax, then whatever income I make, I also pay taxes on that. So taxes are being paid twice. And then the last point is about public eye. So because companies have to make their statements public, as a result, the company has to file all of its reports, all of its general meetings. As a result, your the things that the company is planning, that can be difficult to remain private. Maybe the competitors get to know something about you and they use it to their advantage and your disadvantage. Hence, this is a problem with the companies. So this was the concept of a limited liability company. I hope all is clear to every one of you. And I consider that all is good. So we move to activity 2. If you people have any queries, you should always know that you can reach out to me anytime to ask any queries that you might face. So now let's talk about activity 2. Let's see what's the requirement. In the following activity, we are supposed to match each statement to the appropriate business arrangement. The options are sole trader, partnership and limited liability companies. So first statement says Isabella wishes to open a small shop 3 days a week and wants to spend as little time as possible on business paperwork and penalties. So this is only one person who wants to do the business. She also wants to decide when she wants to work. So if she is the boss, then only she can do something like this, and she wants to also do less of paperwork and formalities. So the sole trader arrangement is going to work the best for Isabella. Then let's move to the next one. Business will continue even if one of the shareholders dies. So in which of the three arrangements do we have shareholders? Only in a company. So the second statement pertains to a company. Third one says there is a distinction between businesses and its owners. So we spoke about how in sole trader, owner is also same and the assets are also owned by the owner only. If you talk about partnership, partnership also assets were in the name of the partners only. Only in the company we saw that assets were different, business was different. So owner is the shareholders and who is the business? Business is the company. So the third point also pertains to a company. Let's read the fourth statement. Oliver wishes to have his own business in a country where limited liability companies must have a minimum of 2 shareholders. So he wants to do some sort of a business where he only wants to have 2 of the shareholders. So which arrangement do you think is going to be valid here? So now here the keyword is he wants to do his own business. So own business is always a sole trader. So Oliver is looking for a sole trader arrangement. Riley wishes to operate by himself as a builder, but he is concerned that he will be personally liable for legal claims by his customers. Sole traders are also personally liable. Partnerships are also personally liable. So the only option is he should be going for a company. Lee has been running an accountancy practice by herself but is concerned that she does not have the expertise to meet all her clients' needs. So here also I was giving you the being ACCA example. I have my expertise in some papers but not all papers. So because I am not able to meet all of my clients' needs, what sort of an arrangement have I formed? A partnership. So she can bring in a partner who can help her with the things that she is not very expert at. Then the next statement says business is taxed as a separate entity from those who own it. Businesses may be subject to different tax rates from its owners. So who is taxed separately? The separate tax is paid. Sole traders basically pay personal tax. Partnerships also pay personal tax. So who pays separate tax? It's the company. So this statement pertains to a company. And the last statement says the owner's savings are likely to be an essential business source finance. So owner's savings are used in a sole tradership business. So this is how we have learned the 3 different sorts of business arrangements. And after solving this activity, I hope you people are also able to differentiate between these 3 businesses. I will see you people in the very next video where we take this chapter forward. I hope that you people are enjoying studying FA and you people will be regular and consistent in your studies. All the very best. Do feel free to ask me any queries that you might have. Thank you. Bye-bye.